To understand Bitcoin, we must first look at the financial world that came before it. The early 21st century financial system was built on trust. Trust in banks, governments, and payment processors. But this trust was fragile. Power was concentrated in a few institutions, creating single points of failure. Billions remained unbanked, and even those inside the system faced slow, expensive, and sometimes censored transactions. The 2008 global financial crisis shattered public faith. Banks failed, were bailed out, and ordinary people paid the price. It became clear, the gatekeepers of finance didn't always act in the public's best interest. The crisis exposed the need for a new kind of financial system, one that didn't rely on trusting fallible institutions. People needed a system open to anyone, anywhere without permission or censorship. A system governed by code, not by the whims of bankers or politicians. In this climate of distrust, the idea of Bitcoin began to take shape. The world was ready for a technology that could return financial power to individuals. The stage was set for a revolution. On October 31, 2008, as the financial world reeled, a mysterious figure named Satoshi Nakamoto posted a white paper, Bitcoin, a peer-to-peer electronic cash system. The document outlined a way for people to transact directly without banks or intermediaries. Satoshi's solution, a public ledger called the blockchain, where every transaction is recorded and linked, preventing double spending. The network would be maintained by miners, participants who validate transactions and secure the system in exchange for new bitcoins. Satoshi's anonymity was intentional, ensuring the focus stayed on the technology, not a single leader. Bitcoin was designed to be decentralized, leaderless, and resilient. The white paper combined cryptography and distributed computing into a system that solved digital scarcity for the first time. With this blueprint, the foundation for a new financial era was laid. The world had its first glimpse of a trustless digital currency. On January 3, 2009, Satoshi mined the Genesis block, embedding a message about bank bailouts, a clear statement of purpose. The first bitcoins were created, and soon others joined the network. On January 12, Satoshi sent 10 bitcoins to Hal Finney, marking the first ever bitcoin transaction between two people. Early adopters, cryptographers, and cypherpunks mined bitcoins for curiosity, not profit. These pioneers debugged code, tested the system, and built the foundations of the network. Bitcoin had no value yet, but it worked. Value could be sent anywhere, without intermediaries. This period was crucial for proving Bitcoin's resilience and building a community around its core principles. The experiment was alive. For Bitcoin to become real money, it needed a price. In May 2010, Laszlo Hanyecz paid 10,000 Bitcoins for 2 pizzas, the first real-world Bitcoin transaction, now celebrated as Bitcoin Pizza Day. Soon after, the first major exchange, Mt. Gox, launched, letting people buy and sell Bitcoin for dollars. This gave Bitcoin a market price and attracted new users and speculators. By 2011, Bitcoin reached parity with the US dollar, a psychological milestone. The ecosystem grew, new wallets, services, and merchants appeared. But exchanges like Mt. Gox were centralized and vulnerable to hacks and mismanagement. Mt. Gox's eventual collapse would become a cautionary tale. But in these early years, it was essential for Bitcoin's growth. Bitcoin was stepping out of the shadows and into the global economy. The world was starting to take notice. The experiment was becoming a movement. As Bitcoin's price soared and crashed, each cycle brought new users, headlines, and scrutiny. The Silk Road dark web marketplace used Bitcoin, linking it to both innovation and controversy. When the FBI shut down Silk Road and seized its Bitcoins, prices crashed and regulators took notice. The collapse of Mt. Gox in 2014, after losing hundreds of thousands of Bitcoins, was a wake-up call about the dangers of centralized exchanges. The mantra, "Not your keys, not your coins," took hold, spurring better security and self-custody. Despite setbacks, each boom and bust made Bitcoin stronger and more resilient. By 2017, Bitcoin hit nearly $20,000, and major financial institutions began to pay attention. Futures markets launched, opening the door for institutional investors. Volatility forced the world to reckon with Bitcoin as a new financial asset. Bitcoin was no longer a fringe experiment, it was a global phenomenon. Today, Bitcoin is discussed in boardrooms, governments, and homes worldwide. Major companies and financial giants now hold and offer Bitcoin, making it accessible to millions. Its fixed supply of 21 million coins offers a hedge against inflation and monetary expansion. For people in unstable economies or under authoritarian regimes, Bitcoin is a lifeline. permissionless, and censorship-resistant. The network is more secure than ever, with a robust ecosystem of services and solutions. Challenges remain, but Bitcoin has survived every test, proving its resilience. It introduced the world to blockchain technology and redefined what money can be. Whether it becomes the world's reserve currency or remains a digital gold, Bitcoin has already changed the financial landscape forever.